My name is Susan Wachter, and I'm co-director of the Institute for Urban Research, and it's a real pleasure to welcome you here today to this seminar on the future of financing energy-efficient buildings. Today's event is sponsored by the Energy Efficient Buildings Hub, which is a Department of Energy innovation cluster. And I would like to begin by introducing the first panel and apologize and send regrets from Nancy Wallace, who is co-author of a paper entitled Energy and Commercial Mortgage Valuation. She's unable to attend the event today unavoidably and sends her regrets. Instead, we will begin the discussion with a review of Dr. Wallace's research by Matthew Quantinetz, who is managing partner at QBL Partners, a real estate firm focused on capitalizing creative assets. Matt, can you begin, please? Thank you.
Thank you, Susan. Hello, everybody. Very pleased to be here with you all, and looks like we have a great panel ahead. I'm going to go through kind of the highlights of this paper without getting too deep in the weeds. The link to the paper is here. There's some very interesting work there that goes rather in depth. So as an executive summary of this, basically the paper looks at commercial office buildings as intense users of energy, and that their use of that energy, the intensity of it, creates different cost structures because energy prices are volatile. So non-energy efficient buildings are more exposed to that volatility. Existing loan practices, the paper found, provide no incentive for doing energy efficiency, despite the fact that they would have greater exposure to the volatility. So the paper proposes a method for lenders explicitly taking energy risk into the underwriting. Standard underwriting is following managing risk of interest rates, market pricing, default, prepayment, and the authors work to look at electrical and gas pricing dynamics, with the result of differentiating the value of mortgages that apply to energy efficiency buildings. So they first go through talking about how traditional mortgage underwriting works. There's a component of risk management, different variables to sort of deal with those risks by sizing the principal, and of course a different rate for risk. Using these two metrics of loan to value and debt service coverage are the way to size the loan such that there's less exposure to those risks. So just quickly, for those in the room that aren't as familiar with cash flows, basically we have the revenue for the building, and expenses are come out of the income to get the net operating income. In this case, for triple net buildings, which is what the authors focus on, the tenant actually reimburses the owner for all expenses. So the triple net lease means that the net operating income does not have any component of expenses in it, meaning that assessments done based on the net operating income alone will have the energy costs external to the mortgage underwriting, which basically means if there's an energy risk associated with volatility of pricing, that's not captured in the standard underwriting procedure. Normally speaking, the debt service coverage ratio, as we talked about before, has that relationship of the debt service payment, which is right above the circle there, to the net operating income. And again, not to hammer on the same point, but if there's no expense feature to the net operating income, the debt service coverage ratio won't be covering that risk. So the other risks that they are looking at are normally managed by these ratios. The default options are normally simulated out, and prepayments are, which is the risk of the borrower paying off the mortgage early, which actually can be a problem for the lender depending on the structure of the portfolio. But they look at all these things and try to close out those particular options. Energy risks, though, exist in addition to the fact that energies are external to that net operating income. They also have their own types of risk, which are consumption shocks or factor inputs that would vastly change the pricing of that energy. Again, that would have to be taken into account somehow, and buildings that are energy efficient are less exposed to those risks. So therefore, as you take the risk into account of energy volatility and consumption, you should be treating an energy efficient building different than one that is not energy efficient. And that's the project that the paper, again, is working on. So to start off on why they're different, we talk a little bit about the electrical and natural gas systems in the US to show why it is that energy even would be different. There's 3 major networks in the US, and the pricing is affected by sales within those networks at different hubs. And the pricing in those hubs is affected by their relationship to natural gas locations as well as population centers. So this is a map of different auction sites of where energy is being traded at any given time, peak pricing. And it's a little small there, but the main takeaway here is that each of those circles represents a geographic center of a pricing offering. Now, as you get away from those particular centers, the pricing will change, but this particular diagram is just showing that there's huge percentage shifts in how much energy costs by region before even getting into issues of volatility. So if you have a building in Northern California versus Texas, those energy costs will be quite significantly different, and that's not a mistake. That actually is why it's because of the structure of the energy system. So the natural gas market is built off of one gas nodal hub. The pricing is built off of one gas nodal hub in Louisiana. This is basically because it's the center of a lot of interstate pipelines and intrastate pipelines, so it's a good place to pull spot pricing from. And then as you get further away from that area, again, depending on the transportation distance and where exactly you are in relation to geographic centers and demand, pricing will vary. So the first diagram was about electrical pricing varying because of the structure of the network, and here it's about gas varying. So no national market for either electrical or gas pricing. Now, despite the fact that some people will argue that since gas is a primary input for electricity, that these two should move together, their volatility should be the same even if their pricing is different. Here the authors pull out forward pricing to show that the volatility, while it has some similar motion, actually it can be quite different at different points of trading. So the conclusions are that the conclusions of the energy analysis are that energy can be up to 30% of total costs, and there's huge differences in both the gas and electrical volatility, and there's differences in geographic area, so that conclusion being that each building will have to be looked at in a different way based on where it is on these different networks. So how do you look at that in terms of underwriting? One of the biggest problems that we have then is we have to figure out how to measure for these buildings both consumption of energy and volatility of that consumption and the price of the input. So some people will argue utility bills will give us that. There's no actual algorithm that the authors know of that relate the building systems and the qualities of the building to those utility bills. So even if you're able to get those, which is a non-trivial problem, you wouldn't be able to get there from there. Energy Star is a wonderful tool, but is a relative basis comparison. So again, a lender can't use an Energy Star score to directly predict the energy use of a building. So other common options might be regression or simulation. Each of those has particular limitations. So the authors choose to go with benchmarking as the best option to calculate energy use intensities. That's what EUIs are, and then create peer groups around geography, building type, and size. They use some existing data points to pull that from 2 surveys, one of them national and one of them California specific. And they admit there's 2 pretty significant limitations with this way of doing it. One is that there's no accounting there for energy efficiency, one of the things they pointed out as being very important to the whole project, because they don't have this data on the building characteristics. So instead, they assume all buildings in a given region have the same energy efficiency, which is a large assumption. And then 2, there's no differences of climate within the regions that they define. So you looked at the regions on the map saying each region has a different energy price, but then there's also a different factor of inputs due to climate. So within that region, some places could be up in the mountains, some are in the desert, et cetera. They have very different uses for energy. But for the purposes of this benchmarking study, we just assumed in order to move forward. So their process, I won't go too in detail into it, but basically they acquire all this data around the rents, the power, the gas, interest rates, and then they calibrate it to predicted distributions of how that data would work, and then use that to back test their assumptions of rents, energy, and gas back to what they know certain mortgages originated at. So in other words, they start with a bunch of mortgages that they have. They know what value they were given. They assume that all of these factors will go into changing those values, and then they simulate various possible values in order to come back to the ultimate price location, taking into account these things. So just as a little bit of a teaser, I won't go in depth into this, but they create different forward curves for the electrical, showing in this diagram what you could basically look at is the fact that the upper left is Texas electrical rates, and then each of the other diagrams are rates for different eastern regions. So Texas, Eastern, and Western are the three main networks, and all you have to see here is how different each of those curves are. They don't move together at all, and that's the point of this part, and they try to use that to calibrate the correct curve to each project that they're working on. Similarly for natural gas, which has a fewer networks to look into. So once they do that, they use a process called Monte Carlo simulation, which basically does everything that I explained earlier, simulating a lot of different possibilities for what the actual values can be, and they continue iterating until they go till the path matches all the way back to what the known original value is. And they do the same for mortgages. So basically, once they do this, they've calibrated a model that should be able to predict the value of some of these extra variables. So if we go all the way back to the beginning, we looked at the fact that normal mortgage underwriting or traditional mortgage underwriting takes into account certain risks like market rents and interest rates, but not other risks like energy. So what they do now to test through that is they do three valuations of the same portfolio of loans. One of them, they do a valuation that takes into account the basic risks, but leaves out some risks like default and prepayment. So it takes into account interest rates and market risks. The second one, they do the same thing but without using energy. And then the third one, they value the loans with default and with energy. And then they compare that to the actual valuations that were done traditionally. So the basic results of all of this work is that the inclusion of the energy versus the other methods of doing the underwriting can have on average 8.89% values below those of traditional modeling, meaning that the person borrowing the money is getting a better deal on the mortgage because of their less exposure to energy. The reductions were larger for larger buildings because they're bigger consumers of energy and for various reasons might have different energy efficiency characteristics, and the valuation reductions were larger for larger loan-to-value ratios. So their conclusion is that ignoring energy would lead to significant mispricing in terms of those mortgage values. So the author's conclusions, to recap, one is that energy is a very local market, and because energy is a significant portion of operating expenses, it needs to be taken into account, and underwriting can take that into account just by using the location of the building and the level of energy efficiency. Now, we still get very good results on those metrics alone. Obviously, if we could have more data, we could do better, but this advantage of this approach is that it uses information that underwriters already have today through standard engineering reports. It uses existing benchmarking tools. So it's a method that is adaptable for actual market application today to apply these considerable differences per region. So that's the author's conclusions. I'll add a couple more comments. One of them is that there's a focus on office buildings as 18% of primary users of energy in the United States. So 18% of US primary energy use is coming from office buildings using that energy. The market applicability of this kind of work is basically heavily focused on securitization, which I think my counterpart here will discuss a little bit. There are some sampling issues around the timing of this vintage of loans was coinciding with a very volatile and not necessarily standard time to be evaluating buildings. And there are some questions about the statistical samples and CBECs. But the theoretical conclusions here are still very powerful. They're able to price energy efficiency effectively today with current data. And what this tells us is that we need to do this work regionally, but the same method can be applied everywhere. So it's a very scalable possibility to add into the mix in terms of valuing these things. There could be extensions for things like water and sewer, which are big components here, and there could be risk extensions for various energy efficiency components. And then seeing as this is a next steps panel, I think some of the things that could be suggested to extend this further, the PCA is that engineering report that we referred to before. It could be tailored and standardized a little bit more than it is now. The authors made the comment that it's very hard to use it for energy efficiency underwriting because there's no standard format. Also, the Institute for Market Transformation has suggested an energy efficiency scoring, which would deal with the issue that the authors bring up of sort of assuming that everything is the same. It can be derived from the LEED scoring today. And then developing some kind of standard coefficients. The methodology here is probably a little bit beyond what every underwriter is going to be able to do, but there's ways to shortcut some of these conclusions and turn it into something that is extremely useful from a regional perspective.
You don't look like Nancy, but that was a great job. And I'm very, very pleased to introduce our next speaker who will comment on this paper. Scott Moldavin is Senior Advisor to Rocky Mountain Institute and Executive Director of the Green Building Finance Consortium, a group he founded to improve valuation and underwriting practices for sustainability investments in properties. Scott?
Thank you, Susan. I get the more fun job to actually do a critique of the paper. What am I going to actually do? I'm going to actually critique the paper from the perspective of its applicability to scaling energy retrofits and also implications for commercial mortgage underwriting. And so as I was thinking about how am I going to critique this, let me just tell you what the paper itself says it wants to do. And this is in quotes, the strategy in this paper is to develop a commercial mortgage valuation and underwriting tool that explicitly accounts for energy risk of individual buildings. And they're going to do that by accounting for energy risk and underwriting, which Matt explained earlier. And so let me just give you my conclusions up front, and then I'll do a little bit of argument around that. First of all, let me talk about some of what I think are the really strong contributions of the paper. First of all, I think, and I'll talk about this a bit more, but the concept of mortgage valuation is not an commercial underwriting term. It's a term of securities valuation, relative analysis, where you compare different types of fixed income securities, where risk issues and the pricing, in fact, the whole valuation model used is not an underwriting model, but actually a securities analysis model. And it has some possibilities to actually bring energy risk into the context of the securities analysis, which I think is important. Secondly, integrating electricity forwards and gas futures into the concept and the risks related to those in an innovative way is really powerful. Highlighting the growing value of reduced energy risks. Again, that's a key part of this. And providing, and this is an issue with all statistical analyses, and really much academic work, when you try to apply it to the practical level, it actually establishes a hypothesis. The hypothesis in this case is when you do all this stuff, a lot of really cool statistics and other stuff, that a mortgage value increases 0.34% on average if you actually factor in a 20% energy reduction. So mortgage with a 20% energy reduction. So that doesn't have a lot of meaning, doesn't tell me a lot about how to underwrite, but what it does do is establish hypotheses about the potential importance. Also, it also highlights the need for better energy efficiency data, and it's stuff about with the property condition reports is an interesting area. And then finally, what I thought was one of the most interesting things is the creative use. They actually took two data sets, a CoStar data set and a TREP data. TREP is data from this commercial mortgage-backed securities marketplace. CoStar is leasing and value and sale price data. And they actually merged these to get a better database. That's the kind of creative use of data that's going to be important. So let me go now and give you just a summary about some of the thoughts about the applicability relative to scaling. Again, I mentioned the thing about it being for the fixed income securities. My basic thought is that this work does not have a substantial application to commercial mortgage underwriting as far as telling me that. And one, again, is this idea. I mean, I went into 4 authoritative commercial underwriting texts and couldn't find the word mortgage value. And that's because it's a concept that we don't use too much. The slice of risk and value, energy risk related to the volatility, is such a small part of the overall risk picture that I just don't think that the implications that even if you get this right, that somehow that's going to drive you, I don't think that works. And also the model and the tool is too complicated. Matt barely got into it, but there's some very interesting concept, rental drift analysis, some creative stuff in their hazard default model where they had to do prices over 5 years on a monthly basis, doing some creative things. As a guy from the market doesn't believe or trust that stuff, so it can't be applied directly. But how about, now that we know energy price risk based on this work is important and valuable, and I know about energy prices in the future, why don't I just run a sensitivity analysis? Given this building, if I can actually reduce the energy 30%, and I know what the future prices are going to be, I can actually, through a sensitivity analysis, look at the risks relative to the cash flow on a very simple basis that I actually think would come up with a result that would be more consumable by the public. So let me just talk a little bit about, before I got into all the technical stuff, I want to talk about the premise. The presumption that energy risks, as they define in this paper, are critical to lender decision-making in loans. And the reality is that it's just not. If you think about all the other factors, so why don't lenders do energy retrofit loans or any kind of energy loans? The small size of the loans, complex underwriting, the forecast risk, the lack of security, measurement and verification issues. Another big one is organizational. In order to actually have somebody do lending, you have to deal with going out and getting the loans, the demand side. You have to actually then originate and underwrite and close and service. And you actually have to and then you have to have an appraisal management group. And so you have to deal with all of those issues. And so the idea, and there's many issues which we'll discuss in the panel that are obstacles to energy retrofits. And energy risks, and just on a magnitude basis, aren't one of those issues. Second of all, that the presumption that even if I had this information, that the presumption that lenders would be able to reduce, because actually the paper says, now that I know that mortgage values are greater for properties that have energy efficiency, that means that lenders will now start reducing their interest rates and they'll get a benefit. Unfortunately, and this has been a problem in the industry for years, lenders don't do risk-adjusted pricing based on different aspects of risk. It's just something that's not done in the marketplace, at least not yet. So the idea that even with this result that you would have lenders respond in the way that they want, I don't think that's a good idea. Perhaps most important in all my work in finance and in energy efficiency is the lack of recognition that a retrofit is a hybrid between a construction loan and a permanent mortgage. This paper is all about permanent mortgage with existing, but the actual decision to spend money is based on a forecast. And the real key risks are all the forecast, whether the energy model and the actual savings are going to be real. That's the risk. The risk related to the figuring out what the options are and how to execute it and put it all together and do the construction and make it happen, those so dwarf the energy, that it's really, so you have to deal with the fact that these are not just permanent loans, which again is a big problem. That gets this idea of the incomplete definition of energy risk. And then I guess this is a broader question, which is the capital stack. You have rebates and other tax benefits. You have some equity, maybe even some mezzanine. Then you have a permanent mortgage at the bottom. And you can even have a more complex. Energy efficiency has a complex capital stack. And I really believe that the key drivers are more on the equity side. The lenders are really going to be followers here. And it's actually borne out that the demand for finance has been really, really low. So again, that's really just about which question you're asking. And so they've answered the question. Even if I believe the model perfectly, I'm not sure it moves the market as much as the authors may believe that it does. And I really wish Nancy was here. We could have debated this because, right, I'm laying out my hypotheses, and I'd like to hear her response. Do I have just a minute to talk about the critique of the model and the underwriting tool? My experience, if you actually go in and look at the model, there's 3 or 4 things where they merge databases and they're estimating values, and they're doing all. And my experience with estimating values with large databases is that the data doesn't allow you to factor in everything that's important to value. There's so many factors. That's why when I was at a National Association of Real Estate Investment Managers meeting, about the same number of people as here today, there was $2 trillion worth of real estate investment management in those people, and asked, how many people have ever used a statistical analysis to do any kind of due diligence or come up with any number in any underwriting or due diligence? And not a single hand went up. I knew it because I'm of that world. It's because it's very difficult to apply statistical analyses, and actually even the techniques that you use to develop the hypotheses are different than what you'd actually have to do to test it at a property level. The applicability due to time period problems. This is actually one of the biggest problems, because if you look at the energy efficiency stuff that's happened, 2008 through 2011, and even the period earlier on was so different. Any kind of conclusion coming from data, in this case, which was 2002 to 2007, and applying those, particularly default rates. In the commercial mortgage securities market, there was almost no defaults between the time the market started really in earnest in maybe 1995 up through 2008. There were almost no defaults in the commercial mortgage marketplace. Nancy's written a great paper on the reasons for the collapse. But so you take data from there, and the default model is the main way that they actually calculate risk. The way that they predict a risk decrease, part of it is due to the volatility, but most of it is due to the fact that if I reduce energy costs 20% in my simulation, it actually increases my value because my NOI increases. And it's that increased value which they correlate to a decline in default rates. And while there is a relationship between value, it's really cash flow. And I think that working on debt service coverage as opposed to value would have been better. But all I'm saying is that the time period problems make me want to say, really interesting work, directionally correct. I want to go test this stuff. Again, it doesn't take away from what's good about it, just maybe limits, ignores lease structure. Lease structure, the most important risk to any lender by far is rollover risk. Because that's really where you could actually, things could go really bad 3 years out, a big tenant turns. If they don't re-sign, the mortgage could default. This completely eliminates lease issues from all of the risk issues. It was unclear to me if they factored in costs. They assume a 20% reduction in energy use in their simulations at the end to test their model, but they don't actually have a corresponding cost number that they add back in my mind. I did not see it. But really, the bottom line on the model is that because of the complexity, it's almost not testable, and it's difficult, but because they actually talked about, and you make some conclusions, Matt, that you could do this, and I could, with the data that's already there, I could actually apply this. I don't think that's true. It's only for office buildings. The data that they have is only for this time period. I think that it would be a little bit more difficult. I could be proven wrong on that, but I just think that, but I think you could take the ideas from this paper and the hypotheses, and you could actually develop some simpler tests that would be accepted in the marketplace and it could become part of the underwriting process. Thank you.
Thank you, Scott. That was terrific. And I think where we are is somewhere in between. Matt's hopeful that we could actually use this methodology with actual data on regional level to lower the cost of financing for energy efficiency mortgages. And Scott's also hopeful that simplify, apply it with some rules of thumb metrics. And both of these points I hope we can take up as we go into the discussion. But our next speaker, it will directly address the question of mortgage securitization for energy efficient investments. Our next speaker is Baxter Wasson, who comes to us from the New York office at Deutsche Bank, where he is Director of Credit Structuring, managing the structured investment team. And I think the way this is a panel in a sense, but I think we should hear from, we will hear from all of the speakers individually, and then we'll all join together for discussion afterwards. So if Baxter can come up, that would be terrific.
Thank you. I do not have a presentation prepared. I'm looking forward to the panel discussion component of the talk today. But I thank you, Matt, for presenting the information. Scott, I think your response was very interesting. And I would agree with you. Sitting in my seat, the level of sort of deep statistical analysis that we would do in this kind of situation is little to none. And I would agree with you, though, that it really comes down to cash flow, and cash flow coverage ratios are what's going to be much more important. Further, would agree that the time period they picked is an awfully challenging one to feel like in today's market is necessarily statistically relevant to what we're seeing overall. But more generally, my group does a variety of different things. Among the things that we do, though, we focused a lot of time over the last few years on trying to find ways to finance energy efficiency upgrades at all different levels. So industrial, large commercial, medium-sized commercial, and even down to the residential level. And I'd say we've had sort of mixed success at those different levels. The industrial and sort of large commercial space is relatively easy for us to do. Frankly, I think at that level it has a lot less to do with energy efficiency per se as the driver of the credit, but really just what is the company that you're looking at? What's the entity you're looking at? Are they, as a standalone credit, something that can support the debt that they're about to take on? And the use of proceeds just happens to be to do an energy efficiency upgrade. In certain cases, we've isolated energy efficiency as the component that's being financed, but still it comes down to a cash flow. Maybe you're isolating the energy efficiency component into a special purpose vehicle, but still sort of it's the corporate credit that's actually generating the cash flow is what you're looking at with respect to the credit analysis. And again, not so much the energy efficiency savings per se. Where that analysis has come more into play is as you sort of move down the spectrum into more distributed credits, so either small commercial or residential credits. And it's frankly become much more challenging. And to the extent that we've had success in that space, it's actually been through homogenizing those dispersed credits back into effectively a corporate credit through some kind of credit enhancement, whether that's in the form of a guarantee or a very large equity investment. There's various different ways you can sort of basically paper over the fact that you've got a very diverse group of small credits that are essentially very hard to analyze, particularly in today's market post-crisis. I think that the willingness of a bank, and in my seat at Deutsche Bank, we are a principal investor, so we actually are investing the bank's own money into these programs to feel confident that we can take on a diverse group of small residential credits and get comfortable with just securitizing those That's still very hard in this market, particularly where the data is very thin, and I think that Michael's going to be able to speak to some of the improvements that have made in that regard, but there just isn't a lot of data today supporting exactly what the energy savings are, but more importantly, how will the end users, the people who are actually saving that money, will they deploy, how do you capture those savings in a way that's applied to debt service rather than something else? And those are a lot of questions that we've been sorting through. Again, we have had some success, but that's really been to the extent that we've been able to homogenize the credits by getting a credit overlay from either a municipality or a utility or some other party who has an interest in achieving these energy efficiency benefits and is willing to step up. And I think from my own view, that's probably the way forward, is to, in the first several iterations and vintages of these types of programs, to have a party, whether it's a partnership between government and utilities or government and industry, to effectively backstop the credits of these diverse commercial buildings or residential buildings, et cetera, so that you do generate a history of performance on these types of loans, which then, looking backwards, the regular way securitization market can say, okay, we have 5 years of performance here. In fact, the credit enhancement that was provided by either government or industry, et cetera, was never actually used because the homeowners or small business owners, et cetera, actually did perform on these loans. And that's at least in part because the energy savings were recognized, or maybe it's just because they paid their loans. But either way, that sort of statistical underpinning is going to be very important to, from my perspective, to working down the spectrum from the large sort of single credit industrial energy efficiency project down to the lower, more dispersed types of energy efficiency projects.
I'd like to just make one brief comment, which is that what he's saying is totally true. I'm on the Washington, D.C. PACE Advisory Board, and I work on other financing. And what happens is that the financing risk, it's a property tax lien, so it's not a real estate risk or it's a credit risk, but there's still risk there. Actually, doing a retrofit that's a forecast, the problem that risk actually affects the borrower, which is a demand issue. So one of the biggest issues in energy efficiency finance is the demand for the finance, because the risk is not being taken by the finance source and really by the borrowers. And so you may not have to address it from an underwriting perspective, but you actually have to address it from a marketing perspective. And I'm working with a number of groups, including Washington D.C. PACE, on the marketing side. Less an underwriting issue, more of a borrowing issue. So a big ESCO or all the financing that he does, he uses a credit risk. So he doesn't really care about whether the energy efficiency retrofit works. He's got a backstop for that. If I'm a property assessed clean energy, I have a property tax bill, so the risk is they're definitely going to pay the energy cost because they're going to lose the property or the property tax bill, so they won't do that. I don't really care about the energy risk, but the actual going and doing a retrofit and having it work out, that's probably the 10-12% risk. It's not a penny bond 4 or 5% risk. So who's taking that risk? It's the borrower themselves. So you're having trouble. Because if it doesn't work and you don't actually achieve the energy savings, the people that pay the cost are the borrowers themselves. And so we're having trouble convincing the borrowers. And then the commercial side, you also, if you're going to use a property that says clean energy, which is one of the main vehicles, you actually have to convince the first mortgage lien holder. And so the reason that you do this is not underwriting as much as some of these demand side.
So we're beginning to get the panel discussion happening, which is a good thing. And so our next speaker will be very important for our furthering these issues. James Finley, who is Wells Fargo Vice President and Senior Commercial Real Estate Appraisal Manager, has more than 20 years of experience in these issues. And I'm hoping that James will particularly address the question of third-party validators in this set of
Thank you. Yeah, this is a good question we're trying to answer today, and one that a lot of people have worked on answering. My role at the bank is in, let me see, get my slides up here. I don't know how I do this. I'm a real estate appraisal manager, so I hire appraisers. I hire appraisers who value LEED, Energy Star, and buildings with solar PV. I'm the principal appraisal manager for that at the bank. So I've had to deal directly, feet on the ground, in the weeds with these kinds of problems. And thinking about this session today, I was thinking about the conversations I've had over the years with this topic, and I wanted to sort of zero in on what I'd call concepts and missteps, and I'm still working on the title, all right? But it's basically where I've heard people describe solutions, ideas, and in many cases they just weren't cognizant of the realities of banking and loans and underwriting and risk, particularly risk. And so what I did was I put 10 ideas together that I've heard consistently. And Scott, I asked Scott for his opinion on a couple of these, so I get to blame him a little bit on that. But basically I'm trying to figure out, that investment on energy efficiency is not there. Okay, we've got that figured out. And what's it going to take to move it there? And these are topics that came up during that session. So now I'm going to do this. Okay, so I've broken them down into basically 4 sections. All right, so the first one is appraisal and banking, and Scott mentioned this is really, really key. Is that the risk of upgrades for like a retrofit? I describe it as the idea in the shower, the ink on paper, the entitlements, the shovel in the ground, the vertical construction, the building is occupied, and then stability. So each one of those steps diminishes the investment and the financing risk. And so when you're coming to a bank or somebody, or an appraiser is trying to figure out what the value is, it's what Scott and everyone said, it's about the future. And energy efficiency value is the value today of a series of future events that do not happen. Okay, so it's complicated. And understanding your head around that idea, and things like the rate of return is dependent upon things like the weather. I mean, you immediately realize this is risky stuff. Okay, 7 tribes of real estate, these are asset classes. When you talk to people who own office buildings, people who own apartment buildings, people who want to borrow money on a house, you have tribes of bankers, appraisers, investors, owners, who all come to this with different cultures of risk. They have different access to capital. They are, maybe they have cash, maybe they don't. Maybe they have access to financing, maybe they don't. But you can't, getting a one-stop answer to this problem, you have to break it down into these, what I call 7 tribes, okay? And the last one is really about appraisers, and I deal with this all the time, is don't know does not equal 0. It's basically the null hypothesis. It's that well, I don't have any comps, so therefore the value is 0. And well, don't know doesn't actually mean I did all the research, and what I found when I did the research was that the answer is 0. It's something else. It's that I haven't done anything. I'm a guy who walks around and looks at buildings, and I've figured out that I don't know anything about this. So the Appraisal Foundation, through the Appraisal Practice Board, is developing core competency rules for appraisers. I'm involved in that initiative, and hopefully that will make a difference. Okay, there's a basic idea that deep retrofits, which I think is what everybody's trying to do, the easy stuff, lighting, change out some HVAC, I mean, those things are simple. But the deep retrofits, that there's 2 ideas. One is that you do it all. Because when you blend those paybacks, those short paybacks and the long paybacks, suddenly you get this magic soup that's going to drive the deal. Well, there's only one problem: humans. Humans don't work like that. They like to take little baby steps and get their own experience. So that idea, as conceptually sound as it is behaviorally different. And I'm very involved in behavioral economics. Energy is invisible. It's one of the big problems with this whole idea. It's not like selling a bag of tomatoes that the other guy next to you is selling. You don't see it. It's not even a drippy faucet, which get things wet. So that one idea of, blend all these things together and make it work. The timing of the energy investment is, in my experience, works best when it's tied to a capital investment. So if your building needs an upgrade, perfect. Your HVAC air conditioning system needs upgrades. This is where you should follow those those air conditioning trucks around, because that's when the opportunity is. Because that's the moment when instead of getting a 10-ton or 20-ton system, he gets a 5-ton system because he doesn't need a 10 because he's done the windows. Well, if he's done the windows, it's quieter and more comfortable inside. He's got happier tenants. So trying to force a proactive renovation instead of a reactive renovation where you're carrying it along with a system. And these deep retrofits have to consider value beyond cost savings. Scott's got a great book on this, that's where I stole this title, and it's basically value is income, vacancy, expenses, and risk. That's where everything happens, but you have to go beyond there. There's reputation, not the same in every market. San Francisco, New York, Washington, tremendous reputational value and lead. Other markets, not so much. Productivity, everybody thinks there's nothing there. There's hundreds of papers that have been written about productivity. How much is it? I don't know, but it's not zero. And so you've got to start embracing these things, and that's probably a marketing problem as much as anything else. Okay, investments, the whole investment concept, one of the things that really gets me going is something I call the simple payback fallacy. And that's a conversation that looks like this. Well, if I do this, the payback is going to take me 10 years, but if I sell the building in year 5, I'm an idiot because I lost all this money. Well, guess what? If you own a business that carries things around and you buy a trailer and you carry you're making money with this trailer for 5 years, and then you decide to get into a new business. What do you do with that trailer? Do you just pull up to a cliff and drop it off? No, you don't. You sell it. And that's called the reversion. In a discounted cash flow, this is the difference between, I don't know what a simple payback is. I can't even describe it. But with real investing, you look at income during the holding period, value at the end. Net present value, take it back to today. And every time anyone says the simple ROI is this, they're assuming that value at sale is zero. And if you put windows in a building, if you put insulation in a building, keep the receipts, trust me, somebody's going to pay you for that the same way they'd pay you for an upgraded radio in a car. So watch out for the simple payback fallacy. Okay, and then things like incentives, without incentives, things like solar, wind, renewables, these things don't pencil. Well, first of all, every energy source has incentives, has tax breaks, has gigantic things like that. But the key thing on this, and I hear this all the time, is, it takes 20 years to pay back solar. Well, in which jurisdiction? In Hawaii, where a kilowatt hour costs 22 cents, or in Oregon, where it costs 6 cents. Guess what? You're basing your future value on some kind of offset, and that cost of a kilowatt hour, one of the questions I ask, the first question I ask when someone says, is it a good idea to upgrade, what is your average annual cost per kilowatt hour? If it's 6 cents, well, I don't know. But Hawaii, 22 cents? Oh man, I can make that work all day. So that incentive issue is a big one. And I've got a whole thing on solar PV payback, and believe me, I wish it was easier, but it does work in ways that a lot of people aren't giving it credit for. I mentioned behavior. There are a lot of humans in these buildings. What are you going to do about that? Educate them, engage them in making the building better. But believe me, when you look at upside and you read about behavioral economics, the opportunity to gain has the emotional impact of about half of the impact of loss of what I have today. So when you look at the upside of buildings that are high performers, you're actually, and you compare that to a totally flipped over argument, which is where you identify the energy hogs, you engage a completely different part of your brain where people are looking at, I've got this money and I'm losing it every day. Wow, I've got terrible reputational risk because I'm identified as this wasteful, irresponsible person. And that emotionally is extremely powerful. And I think we're going to see a lot of that in New York with the disclosure laws. When the Post has somebody's picture on the cover, this is the guy who has the highest energy use intensity in New York, he is going to have a conversation with his energy manager that day. Trust me. So these problems have been solved before. So this is not doom and gloom. SBA, they've got a lending program, Small Business Administration. You're a small business owner. You don't have a lot of cash. You don't have a lot of credit. You can get a 90% loan-to-value loan. Why is that? And Wells Fargo is one of the biggest, I think the biggest lenders in this space. is because for a bank like us, our exposure starts at 50%. We've got a credit enhancement. The first loss position is covered by the program. So if that guy goes down, we're okay, because we're probably, I mean, it's rare that the value goes down that much. So you've got a credit enhancement, and then the other one is expert reports. There were hazardous waste spills and impacts on property long before the Phase 1 report. And in the early days, the Phase 1 report was really, really, really expensive. Well, now it's a commodity. So what does that mean? Is that you took something which is difficult to risk, you applied standardized reporting to it, you got experts involved, and the banks turned to that guy and said, we're trusting this guy, we are transferring the risk of this situation to this expert with this report. We do that with appraisals, we do that with engineering reports. Every Fannie Mae job I do has a property condition assessment. We rely on that engineer to give us the statistics, and we turn to the federal regulators who regulate our business and say, hey, we're taking care of things, we've got these experts, we've got this due diligence report here, and that's what's going to happen in this space. We're going to have better reports, and they're going to be credit enhanced through loan loss reserves or credit enhancement in some way, and I think that's where the answers are going to come from. That's my 10 minutes, I think. Okay. It's okay. Hey, these guys deserve a point, too.
Thank you, James. Our next speaker is Michael Meehan, who is the CEO of Zero Footprint USA. At Zero Footprint, Michael leverages his substantial experience as a senior executive in energy performance management technologies and sustainable management systems. Zero Footprint is a commercial energy management solution specifically to help building managers benchmark their buildings for energy cost savings. Michael?
Great. I think I've got one of the few presentations here. Do you know how to put the presentation on? I don't know how to use this thing. I don't know how to do it. Where's our tech guy? It should be me, but it's not.
I would walk up there.
Oh, look at that. I guess it is me. We put that on there. You just pop it up and I'll be easy.
Great. So this will be a bit of a departure from some of the things we've heard earlier on. So I'm not a risk analyst. I work for venture funds, different sizes, and software companies looking at energy data. So one of the things that we find in this market, which makes it a fairly unique market, is that risk assessments are done on a colossal amount of data. And some of that data is good, and some of that data is not so good, but very little of it is actionable data. So one of the things that we find in the energy space, especially in the building space, is there is almost too much data to really make sound investment decisions. So one of the things we'll talk about just in a few minutes is how we look at the different types of projects and investments that are going on inside the buildings, both direct to consumer and indirect to consumers, is the way we look at it. Which ones are most likely to succeed and why, and what we think is, the barriers right now on those types of investments and where we think they're going to go.
So, like most things, we'll start off with a quick story. So I'm actually Canadian, and in British Columbia, Canada, there is a type of insurance that you can get for cars. You just go in anywhere, everybody expects insurance, you can shop around, you can just pull it, etc. So in 1992, I was driving in the middle of British Columbia, a town, probably 500 people in the town, stopped to renew my insurance for 6 months, and I looked up on the wall, and there was this thing up there from Meehan, and it was like a class-size sort of size of a placemat. And it was an energy and climate change risk map of the world. And I looked at the dates, and the date was on 1980. So if these guys have been looking at energy risk and climate change risk for years and years, decades, why is it that now we're still in the same boat, but not really know what are the proper investments to make? The point of the story is that it's not really about data. It's about what you do with that data and which investments that you decide to pursue based on that data. So one of the things that we'll look at, and just as a quick level set, is the challenges that we see in energy investment
What my company does, it works with all kinds of different projects, all those funded projects. We do it for green buildings, we do it for carbon offsets, you know. And we help make those programs more successful. So we see a lot of deal flow in the types of projects that work and ones that don't. And it usually boils down to sort of two problems. The availability of quality data, not the availability of data itself, and this whole thing around energy consumer engagement. Engaging the people, in the case of a green building, is going to be a tenant. In the case of a city, is going to be a citizen. In the case of a corporation, it's going to be an employee. But it's at that point of engagement where things fall apart. And this is a really great way to kind of take a look at the different types of investments that you're thinking of making and deciding which ones will work and which ones won't. Just as a quick level set, when I talk about direct versus indirect, this is really how I think of the market. Direct is something like a utility would offer to a consumer. If I can show you I'll save you 10% off your energy bill, will you do this? Well, for all accountants, we would say yes. But statistically, we would say no. We don't do it, even though we know it's going to save us money. Homeowner tax incentives, utility rebates, loans for consumers, all kinds of really, really great projects like that. Traditionally, they don't fare well. I'll talk about why that is in a second. Now, the other side is the things that we're trying to do today. Indirect. Right. Looking at underwriting ESCOs to be able to do large-scale energy efficiency projects, right? Or doing federal investment programs like the Alternative Energy Vehicles Program that the DOE did last year for $4.2 billion, green energy subsidies and so on. So not really going direct to consumer, it's more about providing the infrastructure so that consumers can benefit in the end. Now, one of these approaches has been more successful than the other, but that's not to say that's always going to be the case. So for direct to consumer, I'm really thinking about the low-hanging fruits that we talked about in the marketplace, right? Switching out your light bulbs. How many houses are doing that? You know, what's the uptake on something so simple as it is? That hasn't been good. We're looking at 20% of U.S. emissions really coming from, you know, all of the homes in America. You think that even getting something like, you know, energy efficient lighting legislation put through would be an easy thing, but it's not. And the reason it's not, the reason we're not doing retrofits everywhere, the reason we're not doing the easiest thing is because starting with the consumer is really, really, really hard. And this is one of the things you've heard in a couple of the other presentations today. Starting with the consumer is super difficult. So one of the trends that we see right now is if you invest $10 million, say, in an energy efficiency project in your building, or a suite of buildings, or in your asset portfolio, around half of that is going to engage a consumer, the energy consumer, in some way. Right? It's going to be a tenant, or it's going to be a you know, a homeowner, or whatever it's going to be. What happened? And what we found is the engagement at the end, the successful projects of that 50% of the investment that you put in is actually really, really low. It's sometimes all the way down to, you know, 3-4%. So in something like this, you're looking at a loss of 47% right off the bat because you're engaging the end user. Now, we just heard from some of the other panelists about how it's really, really difficult to assess risk because it's not data. Well, there is data. The problem is this piece right here, that 4.7 million on there, is how do you engage people to actually get them to do something, right? That's the hard part. And so when you're an investor and you're looking at these different projects, it's almost impossible to be able to figure out how to get that engagement up so this can become a good investment. So, you know, one of the reasons that these things don't work, of course, is high costs, right? 10 to 15K per retrofit in some of these homes for a consumer. But the direct financing schemes aren't really uniform. So one utility's rebate program is different than the other. Banks, there's a bank in Canada, Bank Montreal, are the largest banks up there. And one of the things they do is they try to incentivize energy efficiency in mortgage owners by reducing the rates by half a point, you know, 3 or 1. And it's met with some success, but these are outliers, right? The other thing is the lack of actionable data. Utilities have all kinds of information on smart meter data that comes out of homes. APIs, but they're closed systems. They don't engage consumers on that stuff. And so it leads to lack of investor confidence in some of these projects that go directly to the consumer. Now, that's one of the big reasons why they don't do well. On the other side is what I call indirect, which is one of the things that we're talking about here, which is large-scale energy efficiency programs, right? Going in through the insurer, going in through the bank, underwriting escrows, things like that. This also has challenges, right? Complexity, the data's come from all kinds of different places. Very, very difficult to hone in on one set of data to be able to make your risk profile for analysis for your investment. Problem is really compounded by multiple vendors in the marketplace as well. One of the buildings that we were recently involved in had upwards of 15 systems operating in the back end, all doing similar things, that all had to be assimilated somehow for the investors to make a risk profile to figure out if they're going to invest in a project or not. It's incredibly difficult. And there's very few standards. That was brought up earlier in one of the earlier presentations as well. There's very few standards out there on the communication of that data. There's internal standards of how systems work together and things like that. But getting that data out so you can have this handed to an analyst to make an assessment of an investment, they don't exist. But this is the area, this indirect is the area where the funding models do work, right? HUD offers credit-worthy borrowers energy upgrades. Don't, of course, go to homeowners, right? They go to the groups instead. FHA, the Power Saver program, with 25 million, I think it is. So these programs do work. So we're at this point where we're going to see a shift from these conversations from indirect, which is mostly what we're talking about today, to these direct models. This open energy data that is happening in the US right now is a watershed moment for energy efficiency and investment in these programs in America, for sure. You've got things like the White House Open Data Initiative. Part of that is this whole thing around green button data, access to 36 million homes, to be able to publicly access that data and do something with it. One of the biggest problems in the marketplace is that large-scale programs that go direct to consumer haven't done very well because the groups that own the data, like the utilities, don't really have an incentive to be able to provide anything to help individuals reduce. However, there's thousands of startups around the world that do, right? They do have a real incentive to do that. So that's what Green Button does. It provides that data to thousands of software companies to be able to provide those solutions to the market. Apps for Energy platform, you see all of the data from NYSERDA, around Energy Star and so on. As this data becomes more and more open, you're going to see more and more data to be able to provide risk assessment for different types of investments. So it's a shift in the market that's occurring really, really big. So as far as bringing better data to the energy investment discussion, that's sort of my part on the panel, is just talking about how we get better data, where it comes from, and then what we can expect next. And what we can expect today is why we're leveraging the quality data we have now is on these indirect investments. And in the future, what we'll be doing is putting more and more investment in direct-to-consumer investments as that data quality and engagement improves. Okay, thanks.